So as Jonathan said, I'm the supervising attorney and the qualified tax expert at the Low Income Taxpayer Clinic at the Justice and Diversity Center, which is associated with the Bar Association of San Francisco. Next. Okay, so this program is like the basics, particularly of income taxes. And so if we're starting off very basic, the first question is, well, what are taxes? And they are taxes, they're payments made that individuals and businesses are required to pay to the government. So this is something that just living your life, you have to pay to the government. And it is differentiated from fees and fines. So if you go to if you go to Mayor Woods and you pay an entry fee, a small entry fee, that is a fee. That's not a requirement. That's a fee for going in and using it, even though you're paying it to the government. It's not a tax. Likewise, if you park in front of the fire hydrant and you get a fine for that, that is a punishment, not just a general requirement. Next. And why are taxes necessary? So there's a traditional answer that people give, and that still applies to local governments like the city and the state, and that is that the government needs the taxes to pay for services. So everything, the police force, the city and state roads, everything that they do needs to be paid for, and they get the money for that through the taxes. There's a more modern answer when you're referring to a government that prints their own currency, and that is that taxes are necessary to make money valuable. The government prints all of this money and then uses it to buy stuff. But why do people want it? Why are they going to do things for the government for this money? Well, because the government requires that taxes be paid in the dollars that they produce, and people have to pay their taxes, or the government will come and take their stuff and send them to jail. So that makes money valuable to pay taxes. Next. Other uses for taxes include controlling inflation, and that has to do with the money supply relative to the amount of goods and services out there. It's to stop money hoarding, particularly if you have a lot of money held by wealthier people. That's not as useful to the economy as having it flow through the economy and people spending it. So if you tax certain areas, that'll help get the economy going. And then in some cases, the government does it to incentivize behavior. For example, taxes on cigarettes, alcohol, and guns can be used to reduce the people's use of those things. And whereas giving credits, that is lowering taxes to people who use certain kind of energy saving things, that's an incentive for people to save energy. Next. An income tax in particular, it's a type of tax based on the amount of money that an individual or business receives. It is typically calculated as a percentage of an individual or business's total taxable income. Not all income is taxable. Next. A W-4 form. It's a form when you go to when you get a job. A W-4 form is a requirement, at least in America, you to fill out. And when you're starting a new job, and it's used to determine how much federal income tax should be withheld from an employee's paycheck. Next. So just here, I wanted to show an example of it. You've probably seen it. If you had a job, you were handed this and told to fill it out. Next. And so there's a portion on there to to tell them like how you plan to file, what your filing status is. So if you're single, if you're head of household or married filing joint, that's what you expect to do it, how you expect to file at the end of the year. That affects your taxes and therefore how much money they will be withholding. And then there's the next place is to enter the amount of dependents, the amount of that you expect to be taking off of your taxes for dependents and other credits. Next. And then if you have any other adjustments to make for the year, there's another spot for that. Next. And then you have to sign it and return it to your employer. The reason for all of this is because your taxes are withheld during the year, so that you don't get just a huge bill at the end of the year, and also because the government wants to use the money during the year rather than you saving it up and getting interest on it. So that's the two reasons, and that you have money withheld to pay your taxes at the during the year, even though you don't settle up with the government until you file your return at the end of the year. Next. Oh, and then there's a bottom portion that's only for the employers, so you won't be filling that out at all. In addition to withholding taxes for your federal income taxes, your employer will be withholding money for the FICA taxes, and the FICA is the Federal Insurance Contributions Act, and it's a type of payroll tax that is collected by the federal government to fund certain social insurance programs, such as Social Security and Medicare. The FICA taxes are paid by both employees and employers. Employees pay FICA taxes through a percentage of their wages or salary, and the employers pay a matching amount. So typically what will happen is that your employer will withhold money for both your federal income taxes and the FICA taxes, and then the employer immediately, or in a week or so, depending on how big they are, they'll pay that money over to the government. They'll pay the government everything that they took from you for federal income tax, and then they'll pay the government twice what they took from you for the FICA taxes, because they're paying what they took from you, and they're paying their half of it. How much are the how much are the FICA taxes? Social Security taxes are 6.2% of all of your wages, and that's another difference. The FICA taxes are only on wage income, not other types of income. But so it's 6.2 of your wages up to $137,700, and your employer then pays another 6.2% up to the same amount. Medicare taxes are slightly different. It's 1.45% that you pay, 1.45% that your employer pays, and that's on all of your taxes. Plus, if you go over a certain amount, there's an additional 0.9% if the wages. So if you're married filing jointly, it's it's $250,000. You end up paying 0.9% more for Medicare taxes, and then if married filing separately, it's half that, and then for just like regular single people or head of household, it would be $200,000. And so everything I've been telling you right now is primarily has been about the federal taxes, but most states, including California, have a state income tax. And in California, like most states, the state tax return is due at the same time as the federal tax return, and many items on the federal tax return affect your state taxes. So typically what you'll do, you'll complete your federal taxes first, and then you take numbers from that and just put it onto the state tax return, and then there might be some changes or adjustments, but it should be shorter because it's piggybacking mostly off of your federal return. Next. So how does the IRS know that the income that you're claiming is correct, or how do they know if you don't if you don't tell them? So when you get income, there's three different ways it could be reported. One is on a W-2. This is for regular employees. There's also 1099, which there's a wide variety of types of 1099 for a wide variety of types of income. But in particular, if you're what's known as an independent contractor, you will also be getting a 1099 instead of a W-2. And there's also people being paid under the table, which is illegal. And that's where you next. So, and here's a copy of the W-2. You should have received you should have received your W-2 already for 2025. And this is generally what it looks like. The primary number that you're going to be using to put on your returns is here in box 1 that's circled there, and that's the amount of wages, tips, and other compensation that you received for that year. Next. And then the other, I guess, equally important number is federal income tax withheld. So this is telling the government how much has already been taken from you to pay your taxes during the year. And from that is how they'll determine whether you need to pay more or you get a refund. The next box we're going to be showing here is Social Security tax. I went into that's part of the FICA tax that I just discussed. That's how much was withheld from you during the year. Next. And then in box 6, this is the Medicare tax that was withheld. Next. And so this is just an example of an alternate form W-2. What I showed you, the form I showed you before is what you get from the IRS if you call the IRS and ask for a copy of a W-2 form, because you need to fill it out like if you have an employee. And that's the one that they print up and send. The most employers, however, actually end up doing the form themselves. And so it can look quite different, but the boxes are always the same. So, or at least the box numbers. So if you have box 1 will tell you your wages, box 2 the withholding, box 4 the Social Security withholding, and box 6 the Medicare withholding. Next. And then your W-2 will also have amounts that you will use for your state taxes, because you will have different amounts withheld for your state taxes, and you'll find that on a regular form it's there at the bottom circled, and on other forms it can be elsewhere, but it's the same, boxes 15, 16, and 17. So what is a Form 1040? This is the form that you'll be filling out during the year if you have any, if you have enough reportable income. Here's an example. So as I mentioned before, one of the most important things to know at the beginning when you're filing your taxes is how you'll be filing, that is what your filing status is. And there are five of them: single, married filing jointly, married filing separately, head of household, qualifying surviving spouse. All of these have different tax rates, and some of them will have they'll have different rates of the total tax. It'll affect things like your standard deduction, which we'll talk about. So there's a lot of things on your tax return that are affected by what your filing status is. Next. Next important thing is dependents. If you claim a dependent on your tax return, it can often result in a lower tax liability, as it may allow you to claim credits or deductions for the dependent. So you list that you have somebody that's generally somebody who lives with you, not always, but the vast majority of time, it's somebody who lives with you, who doesn't really have an income, doesn't have a significant income, and you're taking care of them. There's a number of rules there, but that's what the dependent is. Next. A tax deduction. These are expenses that are subtracted from your taxable income, reducing the amount of income that is subject to tax. Deductions are typically available for a wide range of expenses, including charitable donations, mortgage interest, state and local taxes, and business expenses, among others. Next. Okay, so an example of a deduction, let's suppose you have $50,000 of taxable income, and this is after we've taken away standard deduction or anything like that, but you have $50,000 of taxable income, and suppose you're being taxed at 10%. Your tax would be then $5,000. But what if you have a $1,000 deduction? Well, then we take that $50,000, we subtract the $1,000, and that means that our taxable income is $49,000. So you would multiply that by the tax rate of 10%, and so you would have the tax would only be $4,900. So that $1,000 deduction, because you're in the 10% bracket, saved you $100. Next. Standard deductions. I have amounts here for 2025. Standard deductions, single, married filing separately, $15,750. Married filing jointly qualifying surviving spouse, $31,500. Have household, $23,625. So what a standard deduction is so normally you put most of what's called itemized deductions on Schedule A. If you don't have enough standard deductions, if your itemized deductions are less than your standard deduction, then you can just take the standard deduction. If your itemized deductions are more, you take the itemized. So this is a minimum amount of deductions that you can take. Another way to think about this is the amount of income you can earn during the year without paying any taxes whatsoever on it. Next. So credits. Tax credits are a type of tax benefit that reduces the amount of tax you owe dollar for dollar. Credits are generally more valuable than deductions as they reduce your tax liability directly rather than reducing the amount of income that is subject to tax. Next, we'll have. Okay, so an example. Let's go back to the example of having $50,000 of taxable income taxed at 10% for a $5,000 tax. As I showed you before, if you had a $1,000 deduction, that results in $100 of savings to you. But if instead of a deduction, you had a $1,000 credit, then what happens is that you take the $50,000, you multiply it by the 10, and you have the $5,000 tax, but then we apply the $1,000 credit, and so your tax is only $4,000. So with a $1,000 deduction, you saved $100. With a $1,000 credit, you saved $1,000. Next. Then the next idea here is refundable credits. This is a different type of credit. It can be claimed by taxpayers even if they do not owe any federal income tax. So if the credit exceeds the amount of tax that's owed, the excess amount is paid to the taxpayer as a refund. The primary refundable tax credits that people generally talk about are the earned income tax credit and the additional child tax credit. Next. So as another example here, let's say that you had, instead of $50,000 of taxable income, you have $9,000 of taxable income that is taxed at 10%. Therefore, that's a $900 tax. If you have a $1,000 credit, then the $900 subtracting $1,000, the $1,000 is more than the $900, so it just wipes out your tax. You don't have any tax, but you also don't have any refund. If you have a $1,000 refundable credit, then when you start with the $900 tax, you subtract the $1,000 credit, that's $100 left over. So you actually get a $100 refund, even though you didn't have any tax due for the year. Next. So do you have to file a tax return? You are required to file a tax return if your income exceeds certain thresholds determined by your filing status and your age. For tax year 2025, the income thresholds are, and I've listed them here, won't go through all of them, but like the top two you should look at, there's the $15,750 if you're under 65, or $17,550 if you're 65 or older, and if you're married filing jointly, it's $31,500 if both are under 65, and then $34,700 if both are 65 or older. Only one is 65. It's somewhere in the middle there. Two things to note here. First, you should recognize, at least for the amounts if you're under 65, those are the same as your standard deduction, because the idea here is that you're again, you don't have any tax due, so you don't have any requirement to file. As we'll see later, you might want to file anyway. But then the other thing here to note, and that should say self-employment. If you have self-employment income that's $400 or more, you still have to file a tax return, even if you don't owe any federal income tax. And we'll talk about that in a moment. Okay, next. Okay, who is self-employed? Well, a lot of people who are self-employed know it, but then there are some people who don't realize they're self-employed. So you are considered to be self-employed for tax purposes if you work as an independent contractor, if you receive a Form 1099 instead of a W-2, if you carry on a trade or business as a sole proprietor, if you're a member of a partnership that carries on a trade or business, or you are otherwise in business for yourself, including if it's part-time work. That's some part-time work you might be an employee, but then others you're doing your own side hustle. That's self-employment. Okay, thanks. How will you know the difference? And it's generally in what kind of form you get. If you're an employee, you should be getting the W-2 form, and there's an example there, like what we went through. If you're an independent contractor, you'll be getting a form known as the 1099 NEC, which stands for non-employee compensation. Sometimes the employer could be wrong about that, and if you feel you've gotten a 1099 when you should have gotten a W-2, I would say call us. That can be a complicated situation, and we would be able to help you go through that and determine whether or not you're correct, and if you are, what to do with it. I'll get into later how to contact us. Okay, next. So if you are an independent contractor, then with your 1040 form, you will be filing a business tax return attached to your individual tax return, and this business tax return is known as the Schedule C for profit or loss from business. Next. And then you also have to file what's known as a Schedule SE to pay your self-employment tax. Self-employed individuals are responsible for paying their own FICA taxes. They do this by making quarterly estimated payments and calculating their FICA taxes when they file their tax return on Schedule SE. For self-employed individuals, the FICA tax rates for Social Security is 12.4%, and the FICA tax rate for Medicare is 2.9%, for a total of 15.3%. Now, why are you paying these? That's because paying in to Social Security, paying Social Security taxes makes you eligible to receive Social Security when you retire or if you become disabled. And then paying into Medicare makes you eligible for Medicare when you retire or if you become disabled, or several other rare circumstances. And that's good for employees, but what about self-employed people? They need this insurance as well, and that's what this pays for. So self-employed individuals, when they file their tax return, that's how they are informing both. That's how they're both paying the self-employment tax, and it's also how they inform the Social Security Administration that they've been paying into the system and do deserve Social Security and Medicare when they retire or become disabled. And if you notice, the amounts here are twice the amounts for that you pay as an individual employee, and that's because there is no employer paying the other half. As a self-employed person, you are both the employee and the employer, and therefore you're paying twice as much. Next. When are your tax returns due? Generally, it's April 15th of the following year. Sometimes this is extended due to holidays or disasters, but for 2025, the due date is April 15th of 2026. Next. Okay, always file on time, even if you owe money. So there are penalties for filing late, and there's penalties for paying late. If you file late, the penalty is 10 times the amount that it would be if you filed but didn't pay. Also, filing on time reduces how long the IRS has to make changes or collect the tax. So there's a clock ticking on the IRS. When you file your taxes, you start a clock ticking on them for how long they have. Usually, depending on circumstances, but usually it's 3 years from when you file your return that they have to come back and make changes. Say you owe more or something, and also they have 10 years to collect the tax if you weren't able to pay all of it. If you don't file your taxes, then you don't start the clock on the IRS, and they could come back 20, 30 years later. And then also, if you've made certain agreements with the IRS, like an installment agreement for a back tax, or you're under offer and compromise, then if you file late, that could break the agreement with the IRS. Next. Oh, I should also mention that another reason to file, you might want to file even if you don't have a filing requirement, if you overpaid, or if you are due something like the earned income credit or the additional child tax credit. You might want to file even if you don't have a requirement so that you can get your refund. Okay, the next thing that we need to talk about is progressive taxation. And this is a tax system in which individuals who earn higher incomes are taxed at a higher rate than those who earn lower incomes. So there are a couple of different ways to do this. One approach to progressive income taxation is to exempt the first portion of an individual's income from taxation, and which would do that, and that's the standard deduction. And the other approach is to have a graduated tax rate system in which different income brackets are taxed at different rates. And we do that as well. Next. So what a tax bracket is, it's a range of income levels that are taxed at a specific rate. So I have here, the exact amounts will be different each year. This is just sort of as a comparison. This is for what it was for 2023. So if you were in the taxable income bracket of 0 to 11,000, again, this is after you've already gone over your standard income. Then 0 to 11,000 left, then that amount is taxed at the 10% rate. $11,001 through $44,725, that would have been taxed at the 12% rate, and so on until you get to if you make amounts over, this is over $500,000, some of it's going to be taxed at 37%. Next. All right. So a really important thing to remember here is that those higher rates only apply to the income that's above the minimum for that bracket. So a lot of people are afraid, if I get, I don't want to get a raise or get a job making more money because that'll put me in a higher tax bracket, then I'm paying even more taxes. No, that's not how it works. So if you look here, the myth here would be that if you earned $120,000 and that puts you in a 24% tax bracket, then you'd be paying $28,800 taxes. But that's not how it works, because if you do earn $120,000, the way it works is that here it was $13,850 in 2023. So that amount was completely untaxed, and then the next portion of it was only taxed at 10%, and the next portion was then taxed at 12%, and then most of it, or almost half here, was taxed at 22%, and only a little bit was actually taxed at 24%. So that they ended up, instead of owing 28,000 or having a tax bill for the year of 28,800, the tax bill was 18,875. This is known as your as the effective actual tax rate. And so the person with $120,000 in income in 2023 would be in the 24% tax bracket, but their effective tax rate would be 16%. Next. So the income tax, because the income tax is progressive, the result here is that about half of the tax of taxpayers pay 96.9% of federal income taxes. And you can this graph shows you how much income people in different income tax brackets made, and then how much they owed in federal income taxes. So at the bottom 50%, they earned I think it's 12.5% of the total income earned throughout the United States, but they only paid 3.1% of total federal income taxes. Whereas if you look at the top 1%, they made 20.1% of the total income in America, but they ended up paying 38.8% of the total income taxes. So that is a progressive system. Now, unfortunately, that's just the federal income taxes. We will go to the next slide. So this shows America's overall tax burden, and so this includes the federal income tax, but it also includes your FICA taxes and your state and local taxes, such as your state income taxes, your state sales taxes, property taxes, all of those put together, and you end up with this chart where you see that. So this was from 2019. On this chart, each tax bracket paid close to what they made of the amount of income. So that means that we basically have a sort of flat tax. That is, people throughout their income brackets, whatever income bracket you are, you're probably effectively paying the same amount as people in any other income, but only because of the that the federal and some state taxes are progressive. So that progressive taxation counteracts all of the other taxes, most of which, particularly like sales taxes and the FICA taxes, are regressive, which means that the lower income people pay a greater share than the rich do. Okay, next. And then as an example of how this affects you at the state level, and so we compare California, which has one of the largest state income taxes in the U.S., to Texas, which has no state income tax, and then see, okay, well, who pays the state income, the state taxes? So this is the burden of the state taxes. You can see that in California, the rich end up paying more of the state taxes than everybody else does. The middle class is actually a little bit more than the bottom 20%, but you do end up with the rich paying more. But if you compare that to Texas, the poor not only are the rich paying considerably less of the state taxes than the rich in California, but the poor are actually paying more of their income. The poor and middle classes are both paying more in state taxes alone than in California. At the beginning, Jonathan mentioned being able to get your taxes done at the library, and that is and yeah, that's in coordination. I forget who it was, but that they're one of what's known as a volunteer income tax assistance, VITA, and you can find VITA sites because there's a lot of different nonprofits are official VITA volunteers. It's a program that's kind of operated with IRS help, and you can go to the IRS website and look up VITA, and if it's difficult getting into the library for you wherever you are, you can find sites near you. There are literally dozens of organizations doing VITA. Another one is called Tax Counseling for the Elderly, which is a similar thing. I know the tax counseling for the elderly, I think, primarily has age requirements. For VITA, they do tend to have income requirements, but they can be fairly generous. I'm pretty sure it's up to it's over $60,000 a year for an individual, and probably double that for a couple. And then describing again what I do, we don't prepare taxes, at least not current year taxes for people. We're a national program that's funded through the National Taxpayer Advocates Office. And what we do is provide free representation and advice to low-income taxpayers before the Internal Revenue Service in audit, appeals, collections, and before federal courts in matters of tax litigation. And we can, when we represent people, we have some rather strict income guidelines, in terms of giving advice, if you need advice about your income taxes, you can call us and we can give that advice for free. That is bound by legal confidentiality restraints, and we can do that regardless of your income. So even if you're over income, you still need tax advice, you can still call us. We receive matching funds from the IRS via a grant program, but we are completely independent and we're not associated with the federal government because we can't be, because we are opposing them legally. And in each clinic, we determine whether prospective clients meet our income guidelines, also guidelines about whether or not we think you have a good case in terms of representing you. Next. And then so we have three things that we generally do. One is educating taxpayers about their rights and responsibilities. That's what I'm doing right now. And as I mentioned, we provide free representation and free advice on people with disputes with the IRS. And we identify and advocate for low-income taxpayers regarding issues that affect them. Next, I believe, yeah. So we can start looking at the questions now. If you want to contact us for any advice, as you can see here, we have the our intake line number in the email. Jonathan mentioned that if you registered for this, then you should be getting this a copy of this emailed later, and so you'll have those that email and that number.
Thanks so much, Tim. Yeah, we do. We have a bunch of questions in the Q&A if you want to take a look at those. And I'll just say I put some links in the chat. The San Francisco Public Library's Government Information Center every year puts together a list of tax resources, where to find forms, as well as lists of places that you can get free tax help. That includes many of the providers that Tim just mentioned. So I put those in the chat. Yeah, please put your questions in the Q&A and we'll work on those. Thank you, Tim.
You're welcome. So so the first one here, if I sell my share of a joint tenancy in common of a property, how will it be taxed? That depends. Number one, I would say it depends on whether or not you live in it. Generally, it's taxed like any other asset. When you sell an asset, you subtract the amount that you bought the asset from what you received, and then you pay an income tax on the difference. And it's a special lower type of income tax, generally called a capital gains tax. If you lived in the property, then depending upon whether it's just you or if it's with somebody else, if you're filing joint and they live there, you can not pay taxes on some of that. I think for an individual, I believe it's I believe it's $250 for a single person, and then $500,000 for a married couple that you can avoid paying taxes on. If you have more specific questions about that to your situation, I suggest contacting us. And then the next one, do retired people have to pay taxes? And the general answer is yes, but that's only on income that they receive. And again, if you're retired, you're not. So there's the limited amount that there's the amount that you can get without having to owe any taxes for the year. And so if you're retired, it's very possible that you will not have to. Just because you're retired doesn't mean you don't pay taxes, but you won't have income you won't have wages to be paying income taxes on, because you don't have wages, you won't have any FICA taxes or self-employment taxes. You will probably be receiving Social Security, but generally, if Social Security is the only income that you receive, that's not taxable generally. If you receive other income like dividends and investment income and stuff like that, that can make some of your Social Security taxable. But I haven't seen a case where a person who only gets Social Security ends up owing any taxes on it. And again, like I said, if you're receiving income from particularly investments and things like that, and that can be enough, and it can make you pay taxes even if you're retired.
Tim, I can answer that. I'll put that information in the chat about the Bayview branch tax prep.
Please share tips for those who sell on eBay or Etsy. Thank you. Yes, you are earning self-employed income. I would definitely make sure that you keep track of all of your expenses with receipts, and I would suggest I would suggest calling me again, because I have some. I can give you more. There's a lot there, and I can go through your specific situation and things that can help you. But you have different bunch of different business expenses. You will need to, if you make more than $400 a month, for the year, you will be considered self-employed and have to file the Schedule C and the Schedule SE and pay the self-employment tax. If the self-employment tax ends up being like over $1,000 a year, you will also have to make estimated taxes throughout the year, or you will have a penalty for having owed taxes at the end of the year. There's a lot more I could say, but that's what I'll say in general. And again, if you have questions about your specific situation, I can give a lot more advice in a consultation. Okay. Let's see. Is the gross wages or wages after taxes and deductions on the W-2? The gross wages are on the W-2. So, and then if you want to know what your net income was for the year, you subtract out all of that, and that's in part what you're doing. You will let's see. Well, no, you want, so you can if you want to do that, you can take the numbers and subtract it yourself to get the net. But it is the gross amount of your wages that will be on the W-2. Okay. Please confirm the Social Security wage base. I believe the amount you quoted, 137,700, is from 2020, and I think you're right about that. That's my fault. I needed to either clarify what year it was or update it. I'm not sure what it is right now. So I apologize for that. It should be more because it is indexed to inflation. And if you have specific questions that you call me as a specific question, I'll be able to look it up there. I'm not in a position I can look it up right now. Can you mention about cryptocurrency and your way to file taxes to report capital gains? Okay, your capital gain, for the most part, the cryptocurrency is treated like any other asset that you own, that you might have to pay, that if you sell, you have to pay capital gains on, and that's done on the Schedule D. the important thing is to keep track of your of what you bought and when you bought it. That's important because how long you held the property can affect how much you're paying, whether you're paying the ordinary income tax rates, or whether you're getting the special rates for capital gains. So yeah, keep track of how much you paid for which crypto coins and when. And the other thing is that there is now a box on the 1040 that you will need to check to let them know that you own cryptocurrency. I think you have to check that box even if you haven't paid. So even if you haven't sold anything. So normally you only report your assets when you sell them. And you just have to have all the records. But yeah, just to finish up the capital gains thing, normally you only have to pay to report things when they're sold, but with the capital gains, I believe, with cryptocurrency, I believe you have to at least let the government know you own the cryptocurrency. There's a little box to check there, even if you didn't make a sell during the year. I know it's almost 2 o'clock. How much time do we have?
We budgeted more time today, Tim. So as long as you'd like to keep answering questions, we can do that.
Oh, okay. Yes. How can we view previous taxes we filed? So generally, it's hard to get the actual. If you're asking about the actual tax return, that's difficult. But what you can get easily is a transcript of your returns for at least 3 years, and you can do that by going online to the IRS and registering with them, and then once you've done that, so that you can prove who you are, because you have to go through this process of giving them your ID, etc. But once you've done that, you can get transcripts of the last 3 years of your tax returns from the IRS. In addition to the transcripts of the returns themselves, that is line by line, what line, line number 1 and what you put on there, etc. In addition to that, you can get transcripts of your accounts, and that goes back not just 3 years, like I can go back at least to 2000. Further, you can get, I think for individuals, they only let you go back 10 years. But you can get account transcripts. That is, for each year, it'll go down, not the return itself, but just, when you filed and how much you owed, and then how much you paid, and just everything that happened on your account and what you end up owing, or if there were penalties assessed, interest, all like that. So you can get that off of the IRS. And then the other thing you can get off the IRS website is something called the wage and income transcripts. So you can look at, for each year, who sent in W-2s or 1099s saying that they gave you money. And you can get that on the IRS as well, the website. And if you have any trouble with doing that, give me a call and I can help walk you through that. If I don't have W-2 or 1099 to report in 2025, can I write off my mortgage interest? I also took out against my investment. I know there will be a penalty because I'm still under 59 years old. Is there a way for me to write off financial hardship to avoid a fee penalty? If you don't have any income at all, there's not a way to write off the mortgage interest, because the mortgage interest, that's a deduction, but it is not a refundable deduction. So, in any sense, so it just reduces your overall income for the year. And if you don't have income, there's nothing to reduce on that. In terms of the penalty, yeah, you'll still be getting unless you meet some other requirements. And I would suggest you call us. You will be assessed the 10% penalty, and then you can work out a hardship deferral, and in some cases, what's known as an offer in compromise. There are ways of dealing with this with the IRS, and sometimes not ending up having to pay. If you call me, that's actually the vast majority of what I do is people who are unable to end up paying. All right. Are we on right now?
Yeah, Tim, it looks like there was an issue with your
okay.
camera. So I stopped the video, but yeah, you're still live.
Oh, I'm still there. Okay, good. So yeah, the vast majority of what I do is helping people who can't pay everything they owe, are in a bad financial situation. Exactly what you need to do is individualized. So in this case, I would highly suggest calling our office, and I can set up an appointment with you and spend half an hour to an hour at least going through what your options are, and then depending upon the situation, possibly representing you. But again, that would need me to know the whole situation to determine whether or not we could represent you. If you're working abroad and are paying taxes in another country, do you still have to file a California tax return? For the U.S., it depends upon your citizenship. So you'll generally have to file a U.S. federal return, even if you don't owe any taxes, in part because you were paying taxes in another country. For California, the results might be the same, but I think it depends upon whether or not you're considered a California resident. So if you were living here long enough to be a resident, then you will still need to file the California return. Again, whether or not you end up owing taxes depends upon a lot on whether or not what kind of taxes you were paying in the other country. But if you were away long enough, you didn't maintain a residence, and you just came back here, you weren't a resident for more than half the year, then you might end up filing. It just depends on whether or not you had income here at that point. If you're a non-resident, if you don't have any income, if you're not a resident in California, you don't have any California income, then you wouldn't need to file a California return. What are the definition of tax credits and refundable credits? I kind of went through that already, but the general, so a credit is a tax benefit that is subtracted directly from the tax owed, and a refundable credits are credits that are considered payments, so that it can reduce the amount that you owe, or you might get a refund for the credit if the credit is more than what you owe. What do you do if you are an independent contractor, but the person you work for does not give you a 1099? Well, if you're an independent contractor and you know you're an independent contractor, and the main thing is to make sure that you know how much money they paid you. So if you know how much they paid you, you can go ahead and file your taxes, do the Schedule C and the SE, and let the government and then pay the taxes. And it's the payor who has broken the law, and yeah, that's my number one thing. If you feel a need for some reason, you can report them if you have some reason to think that it's in bad faith, and you think that, and particularly if it harms you in some way. But generally, if you know how much you earned, then you just file it as a normal self-employed person. If you don't know how much you earned, then you need to first contact them and tell them that you need to be to have the 1099 issued. And if they refuse, then you just have to do the best you can, sort of estimating it. And then I would keep documentation, like if nothing else, notes about all of your attempts to get the correct documentation, so that if the IRS comes back to you and says that they believe that you got more, or that you were involved in under the table relationship and you should be fined as well or something, you have documentation showing that no, you were trying to do the right thing. If there are errors found in the taxes file, do you get a penalty if you do not fix it within the next year, etc.? Do you get interest if there's a credit for you? I'll answer the last one first here. The IRS, if it takes them long enough to determine a credit, then they do pay interest on a credit sometimes, not immediately, but more so, particularly if it's their fault. Although the interest that they pay is, I think, 1% less than the interest that they charge. But yeah, really, it depends on, for them to pay for interest on the credit, it has to be their fault in some way. And so that's rare. So I guess generally the answer is no. Do you get a penalty? But in terms of a penalty for the error, it depends upon the type of error and how much the error is. They have penalties, particularly if it's over a certain amount that's considered a substantial amount or not. Usually there is some penalties. If you feel like that that you have good reason for your mistake, I would call us and we can go through that and see if it makes sense for you to request an abatement. Often I would say you can call them or send in a form requesting an abatement for any reason whatsoever, and on some penalties like that, they'll failure to pay penalty because it was a mistake. They have depending upon the amount, they'll sometimes just as a policy abolish the first time penalty abatement. So definitely, it can't hurt to ask them, and it can't hurt to call us. How is the state of taxes determined? For example, I work remotely for a company in New York while I live in California. Do I pay New York taxes and/or California taxes? I'm pretty sure I know the answer, but I'm gonna suggest that you call us, because honestly, that doesn't come up enough for me to really know the answer correctly off the top of my head. I think it's that you end up paying you should be paying the California taxes. But I suggest calling us and I'll research that and make sure I have a correct answer. Hello, how does overtime factor in? I receive it based upon the time of day I work, not 40 plus hours. How about double time? So generally, this is an interesting one that I need to do more research on, because generally that hasn't mattered really. It's just, they're just paying you more, and then that more goes onto your W-2, and it's factored into how much your taxes are. For 2025, however, and the next through, I think, 2028, most of these types of changes in the One Big Beautiful Bill Act were for 4 years. There is a reduction for overtime, but a deduction for overtime pay. So for that one, that's another one. Give me a call and I can check it. I can research that and give you a better answer. But so normally the answer would be no, but for the next 4 years, I think there is a minor deduction you can get for that. So an LLC offers free tax advice for all population, regardless of income. Advice, yes. Again, for representation, we have strict income guidelines, but not for just advice. I'll tell you, if you make a 7-figure income and have a very complicated question, then I may demur on that and have you go hire somebody. But I've had people of a lot of different income levels calling me, and I give them advice, and I prefer, if it's not going to be, if it just takes the regular half hour or hour to talk to you and give you the advice, or maybe do some research and call you back. If it doesn't take more than 2 hours to give you the advice, I'll do that regardless, even if you're a 7-figure income or something. Thank you. You're welcome. Any recommendations for e-filing now that the IRS is no longer offering direct file? Yeah, the loss of direct file, that was horrible, because it was a test last year and it was phenomenally successful. Yeah, the recommendation is the VITAS, the Voluntary Income Tax Assistance. Again, if you're near that branch of the library, that's a very good choice. Other than that, there's one organization that I talk about a lot, give people advice on, is called TaxAid. They have, I know, a couple dozen sites around during the tax season, around the Hope Bay area during the tax season, and there's dozens and dozens more that you can find on the IRS website. What can I do if I have both W-2 and 1099? Then you put the W-2 income on your taxes at the all of it into box 1, and you report that just as normal income, and then you report what you already paid, and then for the 1099, that's so you have to do both. The 1099 you file with, you do the Schedule C, and that's how you put that onto your tax return, and it all goes on to the tax return. And you'll have to pay the self-employment tax. I will tell you, some people, just as a general thing, so I mentioned if you're self-employed, you have to pay quarterly taxes during the year. A lot of people who have both a W-2 and and they're self-employed on the side, or they have an independent contractor job that gets a 1099 on the side. A lot of times what those people will do is they'll submit a new W-4, which, whenever your sort of life situation changes, you should submit a new W-4, and you can have, there's a space in there to have more income withheld during the year, so that rather than filing estimated taxes, You can just have it withheld from you just have more withheld from your regular W-2 job, and then that helps you pay it as the year goes by. What part of my Social Security is taxed? Generally none, unless you have other income. If you have income that, when combined with half of your Social Security income, puts you over, I think it's $25,000, then you get to where they start taxing half of your Social Security income. And then if you go, there's another threshold where if that half your Social Security plus other income goes over another threshold, then it's possible for up to 85% of your Social Security to be taxed. So you'll never be in a position where all of your Social Security is taxed. If your income is only Social Security, I've never seen it that high enough to be taxed at all. Do you deal with the IRS Chief Counsel? Sometimes. Particularly if you're talking about the people who run from the Treasury Department who represent the IRS at tax court, then yes, I deal with them frequently. And if you're dealing with them, you can call us for either advice, at least advice, and possibly representation. I am in the middle of a divorce. Should I file single and separate file my tax 2025? So if you're in the middle of the divorce, then that means the divorce is not final, and you are considered married. And so I assume you were considered married as of the last day of 2025. So you would not file as single for 2025. You would need to file either married filing joint with the person you're divorcing, or you would need to file married filing separately. Usually it's advantageous to file married filing jointly, but there are rare circumstances where it's financially advantageous to file married filing separately. And there are a lot of other reasons that you might want to file separately if you're in the middle of a divorce, that some of which have to do with taxes, some of which don't directly deal with taxes. If that's your situation, you're trying to decide whether to file married filing jointly or married filing separately. That's another situation where I would suggest calling us. I can go through your personal situation and help you decide, at least, to know what the tax consequences of each one of those might be, and then you can make that determination. Let's see. How about no tax on overtime? How to do that in this year tax return? I think we talked about that earlier. I don't. That's something I need to, newer thing that I haven't dealt with directly yet. So I need to do some more research on that. If you do want to know, you can call me and I can look it up and tell you if you want to do it that way. I do know that it's not a full no tax on overtime. It's a deduction, that partial deduction, that has a lot of requirements to that.
Tim, I just want to jump in. The questions about the changes with the the recent changes on Social Security, tips, overtime. I would encourage people to attend our 2026 tax season update. I believe our presenter that day will touch on those topics. So just doing a quick plug for a future program there.
Yeah, that's good. Sounds like I might want to watch that. Let's see. If one has not filed taxes since 2019, but most likely have a refund rather than owe, how can one find that out? Or say that a person does owe, would they have been told already in the mail or the IRS website personal account? No, you would not have been told. You will, if you do a refund, generally speaking, you have 3 years from either when the tax was when the payments were made, which usually that means during the year, either 2 years from that or 3 years from when it was due. So usually the 3 years from when it was due is longer. So like 2019 was due in 2020, and it would have been due in the middle of 2020 because of COVID, but it was due in 2020. And so in 2023 is when your chance to get that refund ran out. You still might want to file just to, if for no other reason than to protect yourself from the IRS saying that you owe more. But for years that are still available for you, going back 3 years or so, you can go online to the IRS. Like I said, if you set up your personal account, and you can look back 10 years, and what I would look at are the wage and income transcripts. The IRS is the IRS probably wouldn't have filed it if you were to do a refund as like doing a substitute for return if you owe. I've never heard of them doing that. I don't know why they would have anyway, but I've never heard of them doing that. But you can look and see what W-2s or 1099s were sent in on your behalf. So if you've lost all of that, or for some reason like you weren't able to get mail or something, you can go on the IRS website and you can look at the wage and income transcripts for each year, and you can see what was sent in terms of the 1099s and the W-2s, and you can use that as the information to file your taxes and see if you're due, and then if you're due a refund, get the refund again if it's within the last 3 years. Okay, just curious, do YouTubers get to deduct their travel expenses as a business deduction if they post travel videos, even if they have very few subscribers? It depends, probably not. Okay, well, what matters here is whether this is a business and whether or not it's these are legitimate business expenses, and you have to be running. This is complicated. I might suggest calling us, because whether or not you're a business depends upon you running it like a business and having a profit motive. If you don't, then what's likely going, or if it's hard to prove that, it's very possible that the IRS will look at the deduction and say, this is just a hobby and you're posting it to get a deduction, and then they'll grant you the deduction to the extent of any income. So if you get a little, you get a little bit of revenue from the ads, then they'll say, okay, fine, we'll give you the deduction to that point. But this is really just a hobby and a reason for you to travel the world, and so we're not going to grant you the deduction. And then But if you've been running it like a business and you can show that you have a profit motive with some reasonable chance of eventually earning profit on this business, then you might still be able to get the deduction, but it's going to be very difficult. And like I said, I would suggest calling us for advice.
Hey, Tim, I'm going to interrupt because we're just about out of time. I do want to do one more plug. That question about YouTube business expenses. And there were a couple other questions that I think these folks would benefit from our program coming up on March 25th, A Practical Guide to Taxes for Artists, Creatives, and Freelancers. Our presenter that day will definitely cover those topics. So I'd encourage you to attend those. I put the link one more time in the chat. So we are just about out of time. I know we had a lot more questions. I'm sorry, folks. We had so many people attend today, and there were so many great questions. We didn't get to everything. Thanks, Tim, for covering so many of them, and then also for offering to have people contact you for their sort of more individual questions. I think that's a great resource. Yeah. And folks should definitely take advantage of that. We're also going to have Tim back in a couple weeks, Friday, February 27th, where he's going to go over how to choose a tax preparer. So we'll also get the benefit of his expertise on that day as well. Did you want to say anything in closing, Tim?
Just thank you. Thank you to everybody who came. Thank you for these questions. They've been very good questions. I'm genuinely impressed with the amount and quality of them. And thank you, Jonathan, for hosting us.
Absolutely. No, we really appreciate you joining us, Tim, and like I said, sharing your expertise. Thanks for everyone who joined us today. And again, I'm sorry if we didn't get to your question, but please consider attending some of our future tax programs. I think a lot of these topics will be covered in those programs, and then there will be additional opportunities to ask questions. Just another reminder, I will be sending out a follow-up email later this afternoon that will include a link to a recording of this program, as well as a copy of the slideshow, some links to upcoming programs and other resources available through the library. And also, I'm going to include a link to a program evaluation survey. Please just it takes about 2 minutes, fill that out. We do take your responses seriously. We use those to improve our programs and also to come up with new topics. So if there's something, in the personal finance world, or frankly, anything, let us know what you'd like to see at the library. And we do our best to find some experts to come and talk to us about that. So keep an eye out for that email, and I hope I see everyone at our next event, which will be next week, and then at future tax programs. Thanks again, Tim. And
thank you, Jonathan.
And thanks, everyone. Have a great afternoon and weekend. Bye-bye.
Oh, and thanks, Ezra, as well.
Yeah, thank you, Ezra. All right. Have a good afternoon and weekend, everyone.